It's time for us to retire the term direct to consumer or D2C. The phrase is anyway a bit long in the tooth, having been used since the days of the dot-com boom. D2C or direct to consumer used to mean directly selling to end consumers rather than selling through retailers or other middlemen. In theory, doing that would allow a company to offer both lower prices, competitive prices, and higher margins since it didn't have to pay commissions to middlemen. It could have better products which are sustained through a faster innovation cycle since it's in direct connect with consumers, and of course the ability to sell products through its own evolving brand stories rather than the competitive price driven construct. In reality though, few brands today are even remotely D2C. For instance, a huge majority of, for instance, boat sales, 82% by some estimates, come via Amazon and Flipkart, and less than or about 2% comes from directly selling to consumers. The dependence on kiranas and distributors and modern retail has merely been replaced by dependence on Amazon, Flipkart, or increasingly quick commerce companies. Large and traditional FMCG companies, which were once acquirers of D2C startups, have sobered up. Their acquisitions haven't really scaled well, even as they've figured out themselves how to compete with D2Cs. As a result, the acquisition premium for D2C startups has plummeted from a peak which it attained during the post-pandemic days. In some cases, even a 50% discount from the peak isn't leading to deals. If you look at categories, electronics is the largest category and has scaled, but profits have plummeted. In skincare too, there's a downward spiral of competition and price pressure. A great example is Mamaearth, which is now paying the price on the stock markets. While if you look at competition, the likes of Meesho, Firebolt, Bolt, Noise, etc., pushing prices dramatically lower. What is even a differentiating factor? It's hard to say right now. The entire category looks like, and this is what my colleague Sita said, a turnstile with a 2 to 3 year cycle. Brands come in and then they're competitive for 2 to 3 years and then someone else comes and disrupts them. What's the way out? What should modern brands do to build lasting and sustainable brands? How should they cultivate consumer loyalty and connections? What should they even be called? And that's today's discussion. And my first guest is Deepak Shehadadpuri. Deepak is the founder of DSG Consumer Partners. He founded it in 2012 and he was prescient about the potential of India's consumer opportunity back then, choosing to put the word consumer not just into his investment thesis, but also literally his fund's name. Now, venture capital is a notoriously hard and, as a result, opportunistic space, which is why you see VCs often abandoning their investment thesis in a wink when markets or trends turn in a specific direction. But to go all in and put consumer into your fund name back in 2012 was thus a gutsy call. Since then, DSG Consumer Partners has invested in over 80 brands and has over $300 million in assets under management. I love Deepak because he isn't a traditional VC. For instance, he bootstrapped his first fund by putting his own home on the line in 2012. While most VCs will advise their investee companies to bet everything they have on outsized outcomes, they never remotely come close to anything like that themselves. Finally, I've known Deepak since we started the Ken in 2016. He was also one of the Ken's earliest patron subscribers. Welcome to 2x2 from Singapore, Deepak. It's been 20 years since you made your first consumer investment in India, Sula Vineyards, in 2004. And though today's episode is on the D2C space, and every VC and analyst and LinkedIn influencer has a thesis or opinion on that phrase, I noticed that the DSG website does not contain that phrase at all. Why?
Rohan, thank you for having me. Very big fan of the Can, everything you do, the insightful research, and now more recently the podcast. Why does I did not realize that you mentioned it that our website does not have the term D2C. I think we don't think of it that way. As you said, when we started investing in India 20 years ago, I've been investing outside India prior to that. We thought of sort of consumer products are there to serve a purpose. All brands have one thing to do, right? They need to understand who their customers are, understand the customer's problem or needs, and build or create a product to fulfill their need. It's not that complicated. It's a very simple thing. Before you started recording today's episode, we were talking about everyone's favorite coffee brand or coffee experience. Again, and each of us, there are only five of us, and each of us had a different preference. All five of us. That tells you why brands are important, even for a
Or we are
category
coffee
like
snobs,
coffee.
all of us.
All of our coffee snobs, we have a different preference, and that's why brands are important because there's a nuanced approach to the same commodity that attracts each of us very, very differently. So our view is a consumer brand is there to sort of deliver a product or service, a promise, as we call it, and that's the actual product or service, and then it needs to get it to its customer. And for us, product is number one, customer is number two. You can put it in any order you want. Then the big question becomes how do you get it to the customer? And that's the channel. And for us, the channel has never been the make or break of any business, right? If you have a product, you must do right by the consumer. If the consumer wants it in a particular channel, you have to be there or you lose that particular customer. You might take a call that that customer is not important and therefore I do not need to be in any particular channel. And I think it's a journey. On day one, when you're building a brand and you are just at pre-product market fit, you want to know if consumers even think your product is worth it. You might choose only one channel. And keep in mind, when I started doing this, there was no Amazon or marketplaces. The whole concept of sort of internet buying was very different. But the concept of D2C, since the topic is D2C, is I guess the term became popular in sort of modern usage in the late 90s with the e-commerce sort of boom. But if you think back of direct to consumer brands, as when I was growing up and I was spending time in the UK and US, I used to buy things on LL Bean only on catalogs. That's fully direct to consumer. My mom in Singapore used to buy stuff from Amway and Tupperware, which is fully direct to consumer. It might be multi-level marketing, but it's all direct to consumer. So direct to consumer only means when the manufacturer or the brand owner directly sells to a consumer without a middleman or a wholesaler. That's simple as that. So it's a channel you choose. So if we at DSGCP have a view that you need to get a product to a consumer and we are agnostic the channel you choose. Some brands might decide to go direct. Some brands might decide to go through a marketplace. Some decide to have retail stores, which might be their own, which is still technically direct, or through a distributor. But you just need to go and build a business with the right unit economics for that brand. And our view is if you break out and become a very successful brand, then becomes the hard question. If you started in one channel, do you need to become sort of omni-channel and enter other channels? Yes or no? And how you make that journey happen?
Great. All right. I mean, I can note. I noticed that Sita is vigorously shaking his head when you were talking about the channel cannot become your business model. It's just one of the things. It's something that Sita keeps drilling into our heads all the time. But I'll come back to Sita. Let me introduce my second guest, Ajay Thandi. Ajay is the co-founder of Sleepy Owl Coffee, a coffee brand. It started out as a cold brew focused company selling bottles and cans of pre brewed coffee with a quote unquote super easy vibe to them. But now I see that they sell even instant coffee, quick brew bags, and ground coffee. Incidentally, Sleepy Owl Coffee was founded the same year as the Ken 2016. Sleepy Owl Coffee has raised over $10 million in venture funding since starting, including, and this is a disclosure, from DSG Consumer Partners in 2018. Before co founding Sleepy Owl Coffee, Ajay was an investment banker in New York. He's currently based in Mumbai, Ajay?
Delhi.
Delhi. Welcome to 2 by 2 Ajay. Tell me, are you a D2C brand?
Hi, Rohan. Thank you for having me. love reading the Ken, and it is part of my daily coffee ritual to open an article, have my French press coffee, and start my day.
Thank you.
Um Sleepy Owl is, as Deepak likes to call it, a challenger brand or insurgent brand, or as how we started was, let's disrupt the space of coffee. Because back when we started, uh, coffee and like other consumer products in the country are commodities that need to have their own uh, nuanced approach to reaching to a consumer. If we felt the category had not really evolved, needed to understand the new age consumer, which was the Gen Z and millennials, and we had our own take on it. Uh, D2C, the term when it came to consumer at that time was not as widely used in India. It was just called, let's find a way to sell our products to a consumer. Retail was the only channel. They outright rejected us because they didn't understand what we were trying to do, nor did we have the capital to, pay the listing fees. So we were lucky at that time. Shopify had just entered India. We put up a website, emailed our friends and told them to email all their friends, and that this is the link, buy our product, and if you like it, we might have a real business. And I think over the next 3-4 years, that term that was just a channel became a moniker for challenger or new age brands or insurgents. You might call them disruptors, insurgents, challengers. D2C in India is, in essence, it's our colloquial version of that. New age brands are called D2C brands, but if you go into the technical definition, no one is D2C that I can think of, right, at all.
All right. All
Purely
right.
D2C. Yeah.
Okay. Okay, I'll come back on that, right? Let me introduce my third guest, Sitaraman G, or Sita. Based in Mumbai, Sitaraman is the Ken's deputy editor. He's also an avid and long-time observer and writer on India's retail and FMCG sectors. He writes a weekly newsletter called Trade Tricks, covering e-commerce, retail, and FMCG, which is personally one of my favorite newsletters from the Ken, and that's saying a lot. Welcome to 2 by 2 Sita. Tell me, do you feel the phrase D2C makes no sense in India?
Thanks, Rohan. Good to be back on 2 by 2. Yeah, in the Indian context, it makes no sense whatsoever. Okay. Ajay said it's become a catch-all for an insurgent or all insurgent or challenger brands, right? I would actually sort of take it further and say it's become a catch-all for all brands selling on any marketplace, online marketplace, right? And I think we journalists are the most culpable, when it comes to the use of the term D2C. I think
because the companies said D2C, so journalists said, well, I guess we'll also call it D2C.
Maybe sometimes, companies don't even say D2C, right? It's just a VC-backed consumer startup, right? And then when you write, you're like, okay, say all these the likes of Traction, which need to club all these companies
Correct.
under a particular umbrella.
So you're not from HUL, you're not from PNG, so you are a D2C brand. Okay,
exactly.
I know what you mean.
So I can't think of a single D2C brand. D2C as we understand it, right?
What about March Tea?
Huh?
What about March Tea?
That is D2C. Yes, that is.
All right.
Truly.
Okay. I mean, exceptions don't prove the rule, but still, let's.
Yeah.
Okay. All right. And let me introduce my fourth guest, who's also my co-host, Praveen Krishnan, aka PGK. He's a much more keener enthusiast for new age Indian consumer brands than me. I've seen him sport Neiman shoes, drink Sleepy Owl coffee, and wear Rare Rabbit jackets. PGK, are you the C in D2C?
I will just say that I may be the C in D2C, but you are completely non-discerning, Rohin, because I do not wear Neiman shoes. I have not tried Sleepy Owl coffee, but I do have a Rare Rabbit jacket, which I really like. So
we're going to change that now.
No, we are going to change that. So by the end of this conversation, this is actually a sales call disguised as a podcast. So Ajay is just going to hear to just make sure that I try Sleepy Owl coffee by the end of it. No, I think, see, my... this thing for D2C or my confusion about D2C actually dates back because I started off my career in e-commerce. I used to be one of the earliest product managers at Myntra. And at that point in time, this aspect of D2C did not really exist because all we did was just go to larger brands and try to get them into the marketplace. So since later, like Rohin spoke about brands like March Tea, so I think brands like that had started coming out and saying we are going to bypass the marketplace. In some cases, they don't do that as well. In most cases, they end up on the marketplace as well. But I really didn't understand what D2C is. And my view of D2C, quite frankly, is very colored by something that Rohin does not use, which is Instagram. Whenever I see a brand on Instagram and I find a way for me to buy it on Instagram, mentally, I have always bucketed that brand as, okay, this is a D2C brand in my head, which is probably a little unfair, but that's also a channel in its own way. So I'm looking forward to this discussion to find out what's really happening.
I want to bring in two elephants we haven't spoken about because they have had a huge impact on the whole ecosystem, and I think has led to many of the irrational decisions. Number one is venture capital. It's part of my business.
I knew that was coming. Thankfully, we are blaming each other. Up till now, it was blaming journalists. Now we're blaming VCs.
No blame.
as
No.
well.
We as a community deserve a lot of blame. The whole idea of house of brands. Think of L'Oreal. L'Oreal is 37 brands, of which 31 were acquired over 100 years. It's a house of brands. So is Unilever, so is P&G, so is
WPP.
Mondelez, so is WPP. Sir Martin Sorrell is his own league, man. It's a house of brands, break it up, buy it out again. The reality is these models work in a different context. Okay, here comes along venture capital. Typically, they have 10-year funds. They want to hold for 5 to 7 years, and they need to get out. So they look at models that were built over a decade or multiple decades, and they say, let's play it out in 7 years. Let's sort of compress it. Use sort of use an algorithm and compress it. That's number one. Number two, and I say this with good intent, it's very hard to build a brand. So when we meet the Ajays of the world, or we meet Rajiv Samant or Viraj Bahl, who wanted to build Sula, who wanted to build Viva, there was no conversation about exit or when your exit is going to be. We know we're going to monetize the asset. As a venture capitalist, I say if I do a good job and the brand becomes salient, I will find someone to buy my shares, because in a good business like Viva and Sula, every month is cash flow positive. Okay, you can put a free cash flow multiple. There's no earnings multiple, no adjusted EBITDA, no nonsense. Yeah, it's a real number. The problem with venture capital is they foie gras money to make you grow faster. But we know foie gras is not good for you. And number two...
Deepak, are you sure you're a VC? You don't sound like one.
Okay, and number two is you've attracted, alongside the Ajays and Virajas and Rajivs, you've attracted a whole cohort of really smart kids who have no passion about building brands. All they want to do is make money and do things because the VCs have told them, and including friends of mine, who've told them this is the right way of doing it. So I think the industry is in many ways broken. That is why we set up DSGCP. We said consumer brands need a totally different playbook. Over the last 12 years, we've seen Kanwal and Kannan
Fireside
have done a great job. Manu at Source is on the mission. So there are a few of us who are on this mission. But you still have the traditional generalist funds, I'm not going to name them, who come in, play consumer for a while, then they get burned, then they disappear. And guess what? They're coming back again. So I've lost 2 deals recently to more generalist funds. I'm seeing concepts of exploding offers. We don't accept my offer in 24 hours. I'm taking my offer away. So all the bad behavior that comes along with hyped markets will come and go, because most people don't stay in the industry long enough. So I think as we talk about what's going on, you have to add the layer of where the funding is coming from and the pressure that my VC community is putting on the Ajays of the world to deliver unrealistic outcomes in unrealistic duration. So you need to find the right investor for the right playbook, for the right business model. I think if once you align on few dimensions, I think the discussion becomes very different. If there was no venture capital involved at a too early stage, I would argue the house of brands phenomena globally and in India wouldn't have played out, because all of them raised real venture money on terms you can read in your own publication, and then were told to go out and acquire brands. And they were buying brands at crazy multiples.
So I mean,
in
that's
some
not
senses, sorry, Sita, I think, I love this, this point that Deepak made. It's essentially like venture capitalists raise money and, right? And then they can't sit on it. They have an incentive to deploy it. Otherwise, their LPs will ask them, what are you doing with this money that you raised, right? And then they go and invest in founders and in companies and say, here's the money. I mean, I'm talking in the context of House of Brands, right? And then they're like, look, you raise this money and do something with it, which bulks you up as quickly as possible. So the flow of have money, do things later in some senses for me is inverted. Because typically you need to have a reason to raise money and then do something with it, right? When that gets inverted is when things go haywire. Because you have money and you're expected to do something with it. Obviously, whatever you're going to do 90% out of the times is not going to be sustainable. But sorry, Sita, you were saying something.
No, I mean the fundamental problem with roll-ups, house of brands in India is that, or even in the US, is that you put the cart before the horse. Ajay said there's no hero brand, right? You get a bunch of brands, and before you even figure out what each brand stands for, you are telling them, oh, I can put you on Amazon, I can put you on Flipkart, I can take you to Target, I can take you to Walmart, right? But what exactly is this brand? Who are its takers, right? We don't know that. But you're hoping I'm going to somehow get 10 brands together and cross-sell, take them to as many outlets and marketplaces as possible, and we'll somehow figure it out, right? And say the brands that, all the Indian roll-ups acquired, right? I'm not familiar with any of those brands, right? Sure, they'll say, oh, they're doing 50 crore, 70 crore in revenue on Amazon. But that doesn't mean much. We've seen what happened with Boat, right? When it filed to go public, it was actually profitable. With Zomato,
Sorry,
wasn't.
tell us what happened with Boat, because I think that's also an interesting cautionary tale.
I was really impressed. I looked at the DRHP. Obviously, there were red flags, like the figure that you mentioned at the start of the podcast, which is that 85% of your revenue was from marketplaces, Amazon and Flipkart, right? And 2% from their own website and app. But they were profitable. And so they were probably the first to tap this sort of, the sort of demand for branded but cheap electronics accessories, right? But there was no differentiator at all, right? When our colleague Gaurav did the story, did a story on, the troubles of Boat and noise, right? He walked up to a mom and pop store and asked them. So he said they basically tell consumers, no one walks in. Very few people walk in wanting a Boat, speaker or pair of Boat headphones, right? You go in and say. You ask for Boat, they say, no, Boat is not really great. Why don't you try, Noise or Bolt or Firebolt?
Whoever
whatever.
is offering the retailer the best
exactly,
margins.
Right? And now you go look at Amazon, the pricing. Go to Meesho. You'll find, Meesho claims that they have gotten rid of all the knockoffs on their website, but I don't quite buy that. You go to Meesho, you do find headphones that look like AirPods. They're called AirPods Pro, $300. Okay, $400, right? If Boat is charging $900, and I know that it's not going to last for more than a year and a half, 2 years, I might as well pay $300 and be happy with it for 6 months and then buy a new pair, right? So where does this end, right?
So we have fast electronics as a category. Fast fashion is old. Now, in the context of what Sita is saying, and I think a lot of our discussion is truly what makes, or when you're investing in a brand now, given that you're a long-term investor in this space, you do want your brands to be around 10 years from now, 20 years from now. What's a sustainable and defensible strategy for a consumer brand today? Because we've seen competition is intense. Followers will come and undercut you on price, copy every feature that you have, possibly offer higher margins to retailers to undercut your space on their physical or virtual shelves. Consumers are fickle. Discounting is rampant in India. So
I'll add one more thing, which is it has never been harder to reach a customer than it is today.
The cost, which Ajay mentioned, right? The
yeah.
cost to reach a consumer. So in this kind of a really intense situation, what's your advice to prospective and current consumer brand founders on how to build something which is sustainable and lasting.
The good news is nothing's changed in the last 100 years. It's always been the same. You need to understand your core customer. That's the core. What does Rohan want? What does Praveen want? What does Sita want? What does Jay want? Uh, Number two, you need to build a product that's solving an issue. There's a problem. You need to provide a solution for something. If there's no problem and it's just nice to have, it may or may not work. And the most important thing is building that love. Why do people love that brand? Okay, it's not that physical, tactile, liquid, or it's not only going to be the coffee. It's what Sleepy Owl stands for, what the brand stands for, what are the memories that come back with it. Keep in mind, I'm going to use Sula as an example because it's the first investment I did. I invested in Sula in 2004. Company's revenues were 3 crores. It's now publicly listed, $500 million valuation. It was the first of the new age wine brands. Now there are many others. But if you ask the consumer who've been with us for 20 years, for many of them, they said the first ever bottle of wine I had after finishing HR college or IIT was a Sula. I could have been in Goa, could have been in Delhi, could have been in Bombay. I was with my girlfriend, I was doing whatever. And it's a brand that's grown with me. And Rajiv stood for the new Indian. Born in Maharashtra, went to Stanford, came back to India. And then Sula Sun reminds me of something. It's a story. The fact that it's an Indian wine for India, there's a lot of nostalgia, it's a brand that you can trust. Every 2 or 3 years, we bring out different varietals. It's a challenge for Sula now. I'm still on the board, so I
Yeah,
can't say
there's
that
a much crowded space now in
It's
India.
a much crowded space. So again, what do we really have? The only thing we have is our brand.
If you'd like to listen to the full episode, you can head over right now to the Ken and become a premium subscriber to catch up on everything else that we've discussed. Your premium subscription will also get you access to all of our long form stories, newsletters, visual stories, and all the other podcasts that we produce. Or if you want to just sample full episodes of 2x2, you can do that by becoming a premium subscriber on Apple Podcasts at a really great monthly price. Lastly, if you enjoyed listening to this episode, let us know by rating the podcast on your favorite podcast streaming platform. Thank you for listening, and we'll be back next week with another exciting episode.